All right, welcome back. Now that you've reviewed some of the foundational things to know about the kinds of equity models that you'll likely be using with your wealth management clients and have seen some real world examples, it's time to move on to the next topic, which is probably the most important topic of all: sourcing your models. You may have noticed throughout this course that I've been referring to roles in the modeling process that I don't typically refer to in my other courses. I've mentioned things like the analyst that's assessing the target price of equities, or the manager that's managing a particular model. And I want to spend some time here talking about that. Creating equity models, and specifically creating high caliber equity models that maximize investment return while minimizing investment risk, is not something that everybody is equipped to do. It takes a significant amount of education, experience, and technical know-how in order to construct an equity model from the ground up that can compete with the products and models that are already out there in the marketplace. Model building is also very time-consuming, and unless an advisor has dedicated resources on their team that can monitor and trade individual positions throughout the day, other parts of the business will suffer due to the time spent on modeling activities. In fact, from my own experience and from the things that I've observed in the industry over the years, I can tell you firsthand that the majority of advisors, from junior financial planners all the way up to tenured portfolio managers, do not handle all of their model construction and model management by themselves. This is for a number of reasons. First off, as I mentioned, without the time, tools, and knowledge that are required to create best-in-class models, an advisor can introduce significant risk to their clients, their firm, and themselves by creating and using models that aren't properly vetted with their clients. We've also discussed in previous courses the litigious nature of this industry. Clients in most jurisdictions are protected by stringent regulations and can, and often do, sue their advisors when they've been financially damaged by poor advice or investment management practices. It's for these reasons that many banks and wealth management firms coach their advisors to defer to the experts when building models. The other reason is scalability. If an advisor is spending a significant amount of time on their models, they're trading off time they could be spending building their practice or deepening relationship with their existing clients. So if it's a best practice for advisors to bring in the experts when it comes to their models, how is that done? The first potential option available to advisors is their firm's internal investment office. An investment office is a centralized internal team of researchers, analysts, and modeling professionals that support advisors in the field. Most large banks and wealth management firms have teams like this, and this is one of the benefits to working with a large organization. Often, these groups provide access to institutional-grade investment strategies, portfolio management advice, and goals-based models and portfolios for private clients. Frequently, an internal investment office will build and maintain a series of proprietary core models that are available to all advisors that work for the firm. These models are very helpful as they allow advisors to adopt and implement a model-based investment approach in their practice without having to do the heavy lifting associated with creating their own. In my opinion, this is the best way for a newer advisor to build this way of investing into their business and getting their clients used to this investment philosophy. Should they wish to do so, advisors can use the models created by their internal investment office as the foundation for their own proprietary model by making some security substitutions or adjusting the weight of specific positions to match the advisor's own thesis. This is a relatively safe and easy way to set yourself apart from your peers without introducing a material amount of incremental risk to your clients. Some firms' investment offices will go a step further and actually help advisors develop their own proprietary model. If this is a service that's available to you at your firm, you should definitely consider taking advantage. Having access to professional resources that will help you create a unique offering for your clients is a fantastic perk and is going to help you differentiate yourself not only from peers at your firm, but also from competitors outside. If your firm doesn't have an internal investment office, or if you're an independent advisor, that doesn't mean you can't adopt a model-based approach to investment management. And it doesn't mean that you're on your own with regards to building and maintaining a model. However, it does mean that you're going to need to look outside of your firm for the resources that you require. Generally, if this is you, you've got two options available to you that can help you get to the right place. The first are third-party investment researchers, and the second are asset managers. Let's take some time to talk about each of these options. The first and potentially cleanest option is using the services of a third-party investment research firm. These types of companies typically sell investment research either on an ad hoc or subscription basis to customers. Their customers can be anyone on the spectrum from institutional money managers all the way down to individual investors and anyone in between. Now, I say that this is potentially the cleanest option because as an advisor, if you go with a third-party firm, you're paying for unbiased, independent research that will recommend investment products and strategies without any sort of conflict of interest. This is a straight cash for advice relationship without the sort of potential complications that can come with going with an asset manager, which we'll talk about next. Many independent research firms specialize in particular areas of finance, like in certain countries, industries, market capitalizations, and more. Often, an advisor can hire the research firm to construct a proprietary model for them. The added benefit here is that you can be certain that your model is well built and well researched as long as you're going with a reputable firm, and it's going to be unique to your practice. The downside, of course, is the cost. These sorts of services can be quite expensive, in the many thousands of dollars per year, which may give newer advisors sticker shock. That said, this is something that advisors should consider an investment in their own business and may add considerable value to clients. The final option I want to cover today is using asset managers to help you build a model. As you already know, asset managers are buy-side investment firms that manufacture financial products for a wide variety of clients, from retail all the way to institutional investors. As an advisor, the primary types of products that you'll be using from asset management firms are mutual funds and ETFs. The largest asset managers in the world are almost household names like BlackRock, Vanguard, and Fidelity Investments. So how do you use an asset manager to adopt a model-based approach? Well, the first option is to create a model entirely out of managed products like ETFs. Take another look at the spreadsheet you were provided today, which includes an example of an ETF equity model. By investing in a basket of ETFs in predefined weights, you're essentially allocating capital to a range of different strategies that are professionally managed by the asset manager. You can think of this as a model of models. Going this route is almost like finding a middle ground, as it allows you, as the advisor, to retain the decision-making power around which strategies or mandates to invest your clients' funds in, while outsourcing things like security selection and position weights to the portfolio managers that run the ETFs. Many asset management companies will also provide assistance to advisors in building their own proprietary models. Much like internal investment offices, Asset managers often retain teams of specialized talent specifically for this purpose, and they'll provide this service free of charge. This, however, is where things can get a little bit hairy from an ethical point of view. Usually, the models that these asset managers generate will have a number of individual equity positions, but will also contain an allocation to ETF products that the asset manager sells. This is how the asset manager firm is compensated for this model building service. They know that if they can get one or more of their products into your model, all of your clients who buy into the model are going to end up buying their products. Now, this isn't really something that's offside from a regulatory or a sales practice point of view. So it's up to you as to whether working with an asset manager in this way is acceptable and reflects your standards and investment philosophy. Of course, it bears mentioning that managed products like ETFs always come with a cost called a management expense ratio, which is charged directly to the investor, your client. When a client holds an ETF in an account that you manage, they'll be paying an account fee to you and your firm plus the management fee to the asset manager. This can make the total cost of investment management to your client quite high and may lead to some difficult conversations about the value that they receive for your services. For more on that, please check out my course on effective communication for client-facing advisors. Last but not least, always remember that when it comes to how you run your practice, the world is your oyster. One of the reasons that this industry is so attractive to so many people is the degree of entrepreneurship and independence that comes with being an advisor at a full-service brokerage. You are not obligated to follow any of the model sourcing tips that I've laid out here, but instead think about them as suggested options and best practices. You can always make use of different resources to create something that sets you apart from the pack and meets your client's needs. You can take a model generated by your in-house investment office and tweak it by adding suggested ETFs from an asset manager. You can also pay a research firm for a proprietary model and have it vetted by your investment office. There are a lot of different ways to arrive at favorable outcomes for yourself, your firm, and your clients. Just make sure that you're always aware of all of your options and that you do your due diligence before risking your client's capital. Well, that takes us to the end of today's course. Let's quickly recap what we covered today. We started things off by discussing the importance of the model-based investment approach in a modern wealth management practice. We then ran through three main types of equity models: fundamental models, technical models, and quantitative models, and got into some of the details around how they're constructed so that you can start to think about which of these types of models best fit with your wealth management practice and your investment philosophy. We also covered some sales and communication tips that you can use with your clients and your prospects when discussing these types of models in your daily meetings. Next, we reviewed some real-world examples of equity models. One which was composed entirely out of individual equities, and one that was constructed using ETFs. And we talked about some of the pros and cons of each. Lastly, we spent some time talking about sourcing models and talked about the benefits of working with an internal investment office, an asset management firm, and using a combination of both. I hope you enjoyed today's course. A good foundation in the use of equity models is a key component to a successful modern wealth management practice, and the learning you've done today will pay dividends in terms of client satisfaction and business scalability once it's been applied. That's all for now, and we'll see you in the next one.